Thank you everyone for your patience. And right here is the last session of the day here at the center stage. So, to close the day, we turn to precious metals, and the big question here is whether the really has more room to run. Join me in welcoming our final session, the Global Gold Rush, Safe Haven on FOMO. On the stage, we have Offense YC, a financial market analyst at Just Markets. Together with his panelists, they will analyze and tell you what's coming out to Africa. So everyone, please give them a big round of applause.
2, 1, 2, 1, 2, 1, 2. All right, let's cook. Let's cook. Are there traders in the room right now? Because this one is for you. This one is for you. I believe that after we're done with this little chat, anybody who's actually trading the markets between today and Thursday and Friday should walk away with some valuable insights, all right? Low key, not a signal, but if you clock it, you clock it. If you don't, forget about it. You feel me? So, with that being said, ladies and gentlemen, I would like to introduce to you my stellar, star-studded panel, starting from, well, my left, your right. Bruce, I think you can introduce yourself. Gentlemen, I'm going to give you all just a short moment. Introduce yourselves, let everybody know who we are and why we're here to cook.
Okay. Thanks for having me, Mr. Offense YC. My name is Bruce Chaka. I'm a financial market analyst for HFM South Africa. Thanks for having us. We'll be having a good time.
Yeah, on the stage, you have Gia. My full name is Gia Nonyana. I'm the global market strategist for Prime XBT, both in South Africa and the rest of the world. My background is in equity derivatives trading, commodity trading, and options market making.
All right, good afternoon, everyone. My name is Kabela Matapo, Business Development Manager at Vantage Markets. I've been in the industry for about 9 years now, so I carry a lot of weight and industry-backed knowledge behind it. So yeah, that's what I'm about. So I'm just going to share and drop some knowledge and some gems. Hope you have your notepads and your scripts ready. Let's go.
Hi, everybody. I'm Peter. I've been trading markets for 25 years now, and some of you might know the group PSG Wealth. I was head of commodities with them before leaving to join or to do my own thing. And then now I'm with EBC Financial. So looking forward to the discussion with you guys.
All right, guys. Round of applause, guys. We've got some experts on the topic, all right? So I'm going to open it up with a bit of a segue. I believe we need to lay down the current narrative before we can talk about what the hell is going on in the world right now and how we can navigate gold, all right? By the way, fun fact, it's the only thing I trade. The only thing I trade. I don't believe in being a jack of all trades. You need to be an expert in one or two things, then you can cook. All right, so guys, coming into 2026, gold was exploding higher on geopolitical fears. You get me, all right? We had the war in Iran. We got the president of Venezuela kidnapped. Gold was on a rally. We topped out at $5,500, all right? And at the end of January, coming into February, the Iran war began. The initial response, gold rallied, all right? But now we find ourselves with gold being severely under pressure. And I feel like personally for me, as a trader, this is a new set of events because war equals gold rallying. But we're seeing gold coming down and in a temporary counter-trend move. So what I would like to frame this conversation around, is the market changing the way it views gold? And what do we have to wait for in terms of catalysts to see a rotation back up to $5,500? Because right now, as of current price, as I'm looking, we're trading around $4,500 in terms of gold. That's a $1,000 difference in between January and now, and it's all as a result of Trump. So the first question that I've got for Bruce on my left, with the tensions in Iran driving oil prices higher, we're seeing that oil is going higher. Why hasn't gold reacted like the traditional safe haven that we know?
Okay, for that question, I would love to say this thing. Nothing has changed. Gold is still a safe haven asset. But what we need to make people understand that because the current market condition, which is the geopolitical events that is happening in the Middle East, it's currently affecting the macroeconomic relationships and the monetary policy. So that on its own changes the whole narrative to making the dollar a safe haven.
Beautiful, beautiful. I like the way you articulated that. Bruce is spot on when it comes to the whole dollar analysis because we've been seeing the dollar actually rallying in the midst of all of this based off of the bond yields in the midst of all of this war. So the question that I pose to you, Kia, bro, oil is becoming an inflationary story again in and amongst all of this, all right? The more oil goes up, the more we're seeing the cost of goods and services goes up, all right? We're seeing at the pump, we're paying more for fuel. So if energy prices stay elevated, as they have right now, we're looking at $100 barrel oil, median, all right? So that Middle Eastern instability and oil being higher, the question I put to you, are central banks trapped into keeping interest rates higher for longer?
I think with everyone that knows me, I study the history of neoclassical economics. And in neoclassical economics, what we know about gold is it's the ultimate relative value asset. What I mean by that is gold has no value. And why gold has no value is because it's non-yielding. So a non-yielding asset gives you no future economic benefit. So the relative value of it is it's gold versus another asset, another valuable asset. So you'll always see gold backed against US dollar, gold versus an equity portfolio, and that's how you determine the risk premium on holding gold. So why I say that is that this is just a classical trap for central banks. And the problem with central banks is that they have to look through the first round effects of inflationary pressure because interest rates are designed to kill off demand in any economy. So now when you're dealing with cost push inflation, interest rates are really not going to are really not going to kill the supply side shock and therefore the cost push inflation. So now you're stuck with central banks having to hold rates higher for longer and therefore it's depressing non-yielding gold. And right now, what you're stuck with is a classic dichotomy, with the fact that the US dollar lost its classic importance to world economics for the past 3 years, and then gold replaced that. And then right now, it actually went in the inverse, where the dollar now becomes safe haven, and then the gold becomes non-safe haven and is pulled with the rest of risk assets. And when regression gets there, it's won and everything is sold off. So it was a rush for dollars that really took the shine of the gold, excuse the pun. But at the end of the day, what we really need to be classically focused on is what has gold been traditionally used for in terms of portfolio flows? And it's always been a hedge against macro systemic risk. And does it retain that? I'd say that if you look at the price, it has not really moved. Because classically, if it was a classic risk off, do we not anticipate that gold would be at 2,000? And I think for me, that really is that dichotomy that plays in my mind all the time.
All right, shout out to that. I like the word dichotomy. Somebody write that down somewhere. Karabo, bro, to segue off of what Kia just said, a few months ago, everybody wanted exposure to gold. Like I said, coming into 2026, guys, we saw record highs after highs. If you're a day trader, every single day coming into January, just before the 28th of January, if I'm not mistaken, it was high after high after high after high. All right, we're all bullish on gold. Do you think that sentiment long term has changed?
Well, that's actually a good question, right? Honestly, I believe that's a false narrative. What we're seeing right now is honestly just a FOMO rush. Everybody's running to the next big thing. Because it's like, if you take it back to when Bitcoin came to value, everybody missed the whole entire Bitcoin run. So people now think that gold will become the next big thing, which it really isn't. because there's this new sentiment that people actually don't even know that the De Beers mine actually found more gold value underneath one of their mines, and it's been hidden. So no one really knows the true ounce of what gold actually is at. So with the current market price that it's valued at, is that the true market price when they're still discovering more gold underneath certain mines in our own country we don't even know about? That's not publicized, that's not public knowledge. But then obviously as investors, as people in the space, we dig deeper into knowing more about that. So do we really know the true value of gold? I don't think so. So until we really establish to know the true value of gold, then we can say, yes, we can back gold as something that's valuable. For now, it's more of a FOMO run because no one wants to miss the next big move because everybody wants to make that quick buck to say, hey, I'm a millionaire because of gold. And that's just a FOMO run. It's nothing really truly so because there isn't no true value of gold. And also, how do we say gold is at all-time highs when it's being priced at the US, but then the US doesn't even have gold reserves with it? So that's my opinion on it.
All right. Actually, beautifully nuanced and articulated answer. And that brings me on over to Mr. Van Wyk. We've got our expert in the building. Sir, what I'd like to put to you, given your wisdom and your experience in the industry, have you seen a time like this before where the narrative, like here just assessed, has flipped and gold is not a safe haven and instead is trading like a risk asset like what we're seeing now because of the inflationary pressures and the higher for longer expectations that are a result of $100 plus oil? Have you seen that set of events happen before?
Ufensi, strange enough, now that you talk about it, 2008 comes to my mind. I've been trading, I was a young trader at that stage, but I was about 5, 6, 7 years experienced, and I actually traded the financial crisis, and then you had that flip where gold became a risk-off asset, and that was temporary. So I think it's an interest rate story. As long as there's expectations of rates, and I see the federal fund expectations are, well, they've been for a cut for this year actually, but that has flipped around for staying put and actually a hike early 2027. So as long as that's the narrative, gold starts to lose a bit of its shine. And so I think the big thing here is, from a trader perspective like mine, the big opportunities this year was actually in shorting gold. But, to do that, you've got to have a specific plan set out and know what to do. So, and if you want to, we can talk a little bit later about silver, because I think actually silver has been let's call it the second gear of what has happened this last, let's say, from fourth quarter 2025 early into the beginning of this year. Silver has been the big story actually, and might be a little bit of a tail wagging the dog, but I think silver has actually been driving the gold prices up a lot, and that has, made gold look good as a safe haven, but I think the silver story is actually the thing that's actually been driving it a little bit more.
All right, beautiful. Guys, so because of what Mr. Van Wyk said, what Karabo has said, what Kia has said, and you, Bruce, it seems like we're building sort of like a narrative. You get me? And I think because of that, we're going to go off script. All right? We're going to freestyle this. So, my question to you, because of where the shape of this conversation is going in the direction, do you think that, is it feasible to cut rates in 2026? With the Fed watch tool telling us what Mr. Van Wyk told us. When you look at the summary of economic projections, we were going into 2026 expecting about 2 to 3 cuts. 3 to 4 on a good year. And that's if inflationary expectations were kind of subdued and the jobs numbers were looking decent. So with the whole Iran war and the uncertainty of when oil is going to go back down below $100 for the short to the medium term, do you think that the Fed and Jerome Powell is not there anymore? We're dealing with Mr. Walsh now. So with all of these moving parts, do you think that the Fed is going to cut rates this year?
Based on what is happening now, remember on paper, higher inflationary numbers pushes the Federal Reserve of the United States to increase the interest rates, right? Remember, they are only doing that because now they want to push inflationary numbers back to its bracket. Just like Kia said, now we are dealing with a cost push inflation. That becomes a problem because now, immediately when the inflationary are still heated up, then I don't see the Fed cutting the interest rates. But now it becomes a problem because now what Mr. Donald Trump, like the President of the United States, he wants a dollar to be cut the interest rates because he was pushing Jerome Powell to cut the interest rates. But now, surprisingly so, it's becoming a problem because now there is war that he has started that pushes inflation higher, right? But now for them to control it, they would have to keep the interest rates high, right? So now, as for 2026, I don't see that happening as long as they are delaying with the ceasefire. Remember, even last week, they even said we will be having a ceasefire coming in few hours. But that kept on pushing a lot of euphoria in the market because people were excited. People were excited. They were buying gold because now they were thinking there is a ceasefire. That's why even Thursday on Friday, they saw the market going up because they were expecting, because there is a ceasefire coming up, let me price in. Right? Let me settle out. Let me push my trades immediately when the market opens on Monday, because there will be a ceasefire on the weekend. I will be in the trade. But none of that happened.
Hooked.
So the longer they are delaying that, they can't cut. You get my point?
Right. So, long story short, the Fed is in a tough place. I think this is where the members on the board of the Fed are really going to earn their well-paid salaries. Because right now, they're stuck between a rock and a hard place. How can you cut rates in an environment where we don't know when the war is going to end? The longer the war goes on, the higher the oil price. The higher the oil price, more inflation. More inflation, higher for longer. So with that being said, yeah, do you think Donald Trump is going to pull a taco? Because we all know Trump always chickens out. Yeah. So are we going to get a taco from Donald Trump? Because the midterms are coming up right now. And if he loses the midterms, he's a lame duck president. And right now, the Iran issue is a hot topic for voters. So do you think Trump chickens out and save face? Or are we due for an escalation?
Well, just to comment on the fact that they're very well paid. The max they can get paid is $230,000 a year, which is a lot in South African rands. But Kevin Walsh is the first multi-millionaire Fed chair, because in his reported filings, he's worth almost 150 million US dollars, and his wife is a classic heiress, and she's a billionaire. So it's quite interesting for you to say that. But let's get back to the question, which is firmly not an economic question, but a political question at that. And understanding what were the goals of the United States in starting the war with Iran. They say it was to de-escalate their nuclear ambitions, of which they didn't have any. Then two, as well, what else did they really want? It was Israel's influence over the Middle East. So now, has that been achieved? Because it seems like enrichment is going from 3% to about 56%. So actually, Iran is going to enrich more uranium in the New Deal. And hegemonic interest of Israel in the Middle East are trying to be backdoored through this new Abraham Accords. And I don't think any Middle East nation is going to go for anything on that, whether it's the UAE, Bahrain, or any allies of the United States. So at the very present moment, I think the war continues at a slower pace, but it's going to maintain itself like the Ukraine war and carry on indefinitely up until the allies of the United States buckle under the pressure of the sheer economic pressure of not being able to raise to raise a fiscal revenue through the exporting of oil.
That is a superb answer. Ladies and gentlemen, please give him a round of applause. That was so well articulated. Love it. So, just to piggyback off of what he just said, all right? So, he foresees sort of like a Cold War starting, like perpetuating, all right? We don't see crazy escalations like the first wave. However, we don't really see the Strait of Hormuz reopening, and that keeps oil elevated. So, with that being said, if oil stays above $100 past June, do you think that gold still remains under pressure, or do we rebound at some point on the fear of a recession, which then flips the whole narrative, and I think, in my opinion, makes gold a safe haven or puts it back on track to recapture those recent highs? What are your thoughts on that?
All right, so honestly, if you look at what recession is, right? Recession is created by fear. Recession is not a real thing. Recession happens when investors start getting panic from public perspective. That's when recession happens. If the public does not say, look, I am afraid to invest or give whatever little stock penny I have, investors will always invest in whatever they want to invest in. But then the moment the public literally pulls out from swaying whatever great value that is a specific asset, then recession happens, because it's them saying, okay, if the public isn't backing me up, let me let go. Same thing, if I was president of the USA, honestly, I would have never let go of Powell. I mean, we have a new guy stepping in. He's fairly also in his, fairly young years, per se, versus the great Powell. We all know Powell, we all love Powell, because he's given us the greatest years of value when it comes to the US economy. I mean, he held it down when Trump said, cut bases, and he was like, no. And he stood his ground, and he gave reasons why he stood his ground. So to have someone like that that can literally challenge a presidential decision should tell you that he has the greater interest for the country and the value of whatever dollar aspect is there. So now if you're going to have an individual where now he's being pushed in by governmental power, we're going to get those cut rates coming in literally every quarter. Because why? It is a governmental push. We all know who he's backed by. We know how he got the position. So with that being said, genuinely, I honestly think that there's a sleeping giant that we are not looking into, which is the stock market, which is the indice market. That's where the real value is currently sitting. And we also focus driven on commodities and on the oil situation, that the stock market is growing so much value. It's hitting 2 times multiple highs on a daily basis. And no one is seeing that. Everybody's swayed by the oil prices. Everybody's swayed by gold. But then I'm actually looking at what the stock market is doing. It's performing extremely well. The US 500 has hit numbers it has never seen before. And that is the slower sister as compared to NASDAQ. I don't even want to touch on NASDAQ. It is flying high. So I think we need to literally start switching our attention for people in the room and us as traders on the real value of what really is happening. Everything's just smokes and mirrors. So whatever you see out there, don't go fully on it. It's smokes and mirrors. There's always something behind a narrative that's being pushed. And it's the stock market. They are gaining value in the stock market. If you look into the stock market where the stock currently is, believe you me, you are going to see real value of what the economy projection looks like. And that's what I'd love to urge everybody to start looking into, honestly. And that's my narrative on it.
All right. Thank you for that answer. Mr. Van Wyk, just to kind of wrap this all up in a beautiful ribbon, do you think right now that gold is going to wait for inflation to determine its direction, which is going to be oil-driven inflation or not? Or do you think the path of rates is going to dictate when gold rebounds? Because right now, we're at a discounted level. Again, I segued and premised this entire conversation by saying that in January on the 27th, gold was sitting at $5,500. Fast forward to today, we're sitting at $4,500. Fun fact though, Bruce said that we got de-escalation talks, the ceasefire talks happening about 2 days ago. Gold gapped out at the beginning of this week. Yeah. So, with that being said, you think that gold's fate is ultimately tied to inflationary pressures driven by oil or the path of rates?
That's a tricky question, you know, Fancy. I usually let the markets tell me first, you know. It's, the markets will show you, but if I have to say the inflation slash, remember, inflation and interest rates are connected. So as long as the expectations of inflation are there, whether it's demand or supply, cost inflation, you'll have gold under pressure because of potential rising interest rates. Now, an interesting caveat on gold as a safe haven. If you go look at Iraq 1, Iraq 2, and now Iran, you usually see gold build up into the escalation, and then when the first shots get fired, you'll see the collapse. So we've seen the build and the collapse now with Iran. The question is, gold, it's an asset that traditionally gives about 10% a year. We've seen it go up about 100% since the beginning of 2025. Now, if you're an investor in an asset that you expect 10% a year for, and you suddenly get 100, I mean, that tells you something. It tells you maybe it's time to take the money and, you know, go look for something else, just from a trader's perspective. Now, whether gold's going to catch a bid somewhere, I think gold's going to be different than 1980, when it also had that massive, almost 180% up, where that was a very inflationary time period where interest rates went up to 20%. I'm not seeing that at this stage. So I believe gold is probably, we're not going to see that slump in gold like we had for 20 years, but I do think we've made it kind of an interim top for now, and we'll have to let the market show us. There's a chance we could dip below 4,000. Will I be looking to own a little bit of gold down there? Maybe. But I'll be letting the market tell me. And at the moment, I do think the market's looking at inflationary / higher interest rates into 2027. Yeah.
All right. Now, guys, I think we cooked. What do you guys think? Did we cook? Yeah, for sure. So I think we have time for maybe 2-3 questions. Anybody want to stab at it? Shout out. And that's actually a gentleman, pretty interesting. That gentleman is actually holding real physical gold right now.
Interesting.
Right now in a safety deposit box, locked away safe. So his question is probably going to be interesting. Let's go.
Don't you put me on my spotlight, dog. Okay, my question is directed to all of you. So, you all are traders, right?
Full time. That's what keeps the lights on.
Oh my God, thank you. So, my question is, what indicators or confirmations would you personally require before entering a high conviction gold position right now?
All right. Does anybody want to stab at it, or should I dollar?
Do you catch that?
Okay, you must rephrase that. So, in short, he's saying, what catalysts are we looking for in order to go in again on a potential gold rally? If I heard you correctly. Something like that. Do you want to run that back?
Okay. Let me start. I said, what indicators or confirmations would you personally require before entering a high conviction gold position right now?
Got it. So essentially, as Offense had said, right, gold is currently at a discounted price. So if you're looking for a catalyst, you would wait for prices that are discounted, as he mentioned. That would be the best opportunities for you to look into a catalyst. But then, like I said in my previous statement, not all that shines is gold, or not all that shines is diamonds and glitters. Look for the smoke and mirror and screens. As much as they're always calling for Trump is going to attack and whatever, then come the Monday or the Sunday, then he's calling for peace and a retreat. That should tell you something. That is, like I said, it's all gimmicks. Look into the share value of the US market. Once you start seeing a massive traction and gain on share value on the US market, that day is your catalyst to either leave your asset, because when that share market starts growing, your asset of gold doesn't hold any value. Let go of it. When the share starts decreasing and the stocks market starts decreasing, that day should be your catalyst to start adding more value towards your asset or your commodity such as gold. That would be my viewpoint on it.
All right, thank you, KB. Guys, do you mind if we actually get a stab at that question? That's probably the best question we'll get all day. That's a really good question in terms of like catalysts. So same question to you. Let's keep it short. What are you looking to see if you are going to be trading gold in the short to the medium term, in the next month, between today and a month away, what are you looking to see before you go in on that?
Okay, just to echo on what he was saying, right? Remember the current situation that is happening with gold. It's very critical because now the war is affecting the macroeconomics. So the catalyst or the tailwind to that, based on what I said on Thursday, is the ceasefire. Because immediately if the war keeps on continuing, then it will affect the macroeconomic relationship. And then it will open what we call the domino effect, because it will be the shock, which is happening at the Strait of Hormuz, right? If it continues to be closed, then it becomes a pressure to oil. And when it becomes pressure to oil, it becomes pressure to inflation. Inflation becomes heated. If it becomes pressure to inflation, then it becomes pressure to interest rates. You get my point? So the only catalyst that you will be waiting for is the ceasefire, because we are affecting the energy sector.
That's what I'm saying. That's what I'm saying. Guys, round of applause.
Can I get a
I think you
follow-up?
cooked. Let's go.
Can I get a follow-up?
Oh, if you don't get the signal, you're playing games. I'm just saying. If you don't catch it. So just to piggyback off what he said, I'll keep it short. The catalyst I'll be looking for is de-escalation. If you look at the action-reaction function since the war has began, every time there's an escalation, gold goes down. Every time there's a de-escalation, gold goes up. Look at the Strait of Hormuz. As soon as you start seeing traffic, press buttons. That's what I'd say.
Okay.
What do
just
you
a
think,
follow-up.
KB?
I had a follow-up because he mentioned macroeconomics and inflation. So my next question will be, central banks have been aggressively accumulating gold reserves, right? And then what message does this send about global confidence in flat currencies and monetary systems?
Can you please repeat that, bro?
Oh, central banks have been aggressively accumulating gold reserves. And then what message does this send about global confidence in flat currencies and monetary systems?
I think that one is for Mr. Van Wyk. Okay, and that's between you two. No, okay, oh yeah, for sure. Stab at it.
It's an interesting question. The central banks, I mean, they've been accumulating gold reserves for 10 years, even more than 10 years, slowly accumulating. The effect of that is on gold is actually, I would say, negligible. So obviously it's a strategy of theirs to have the reserves in gold, but I don't think that's the big mover in gold. It's a contributing factor, but if you go look at the gold price movements themselves correlated to something specifically, it's very, very specifically correlated to inflows into exchange-traded funds, the gold physical back exchange-traded funds. So retail, public funds flowing into and out of gold. So and we can get to the silver story as well, maybe, because I think the squeeze we had in silver was actually the big driving force on this last bull run in gold. So yeah, the question was central banks. So I believe the central banks accumulation is a small, very, very small contributing factor to gold being a safe haven. It's just the strategy they follow for almost ever since they've...
All right, lovely. Kia, let's wrap it up. Close it off for us.
Yeah, actually slightly.
And we cook.
Actually, slightly disagree with Peter. I think it is a confidence factor, because I always say fundamentals determine directions of trade, whereas the technicals determine the trigger. So let's get back down to fundamentals. There has been accumulation since 2022. There's been 1,000 tons of gold being accumulated by central banks year on year. Last year it took a bit of a dip. It was about 886 tons of gold. And if you're looking at buying patterns, I mean, in the past few weeks, Turkey, which is the former Turkey, was the biggest accumulator of gold since the start of the war, even though the price is going down. So what can we look at the currency in itself is the Turkish lira has been perennially very weak for the past 10 years, but since the war, it is the weakest emerging market currency right now. So to prove your point in saying that the the lack of trust in fiat currency has led to central banks buying gold. That is just but one case. But I can give you an anecdotal experience of something I've seen recently in some of my research reports. Poland is the biggest buyer of gold reserves right now, year on year. They're increasing their gold reserves by 23%. Why are they doing that? Because they just don't trust the currency. And for me, gold remains the classic hedge against macroeconomics, geopolitical, and macro risk forever. So at the end of the day, the behavior of the momentum, the fundamentals, remain a high conviction on gold. It is just the turning of the indicators. So one I look at is relative strength. It is a continued average relative strength gain that's going to show you institutional momentum. Once there's institutional momentum, there will be a change in the price of gold. So am I buying gold as a safe haven? Yes. Am I buying right now? No.
All right, can I quickly
Let's go, guys. Come on.
Beautiful.
Come on. No, we cooked.
Offensive, can I quickly
Shout out
just jump in
to
there?
the gentleman.
Offensive,
that
can I
have
quickly
joined me
just
today.
jump in there for a second?
Yeah, for so?
I just want to give out something as a quick hint to traders, right? Because you asked about the central bank. So there's a specific range that you guys can use called the CBDR, which is the central bank dealing range. So if you just toggle your charts, if you use TradingView, for example, toggle your charts from ETC to RTC between 5 p.m. US time to 8 p.m. US time. That specific time range will show you the central bank dealing range for the specific day. So if you are a day trader and you're looking to get that central bank dealing range, that is the best time you will see where they stop their pricing and where they're going to index it for the following day. So just look into that. It's just a young gem to put out there for the central bank dealing range.
All right. Ladies and gentlemen, there's so much we could say. Like, we could go on here the whole day, but unfortunately, we cannot. And I'd just like us to give us our panel, our beautiful panel, a warm round of applause, guys. Thank you, all right? Thank you so much for joining us today. Thank you for attention. Thank you for the great question. I love the fact that it was asked by you because you're emotionally involved in this. Guys, he's actually holding Kruger coins. Oh, yeah. So we had a conversation about it this time last year, and I said, let's hold on to this. Let's have this conversation next year. And he came this year, and he asked great questions. Thank you to my panelists. Thank you to FMAS 2026. Let's go.